We want to bring in Sarah Ketterer. She's a CEO and fundamental portfolio manager at Causeway Capital. Sarah, the surge in yields here clearly spooking investors. A lot of investors here rotating out of some of those more riskier names. How big of a threat do you think the jump is that we're seeing in yields?
Well, it depends. If you own overvalued stocks, it's a big threat. But from a value manager perspective, this rise in yields is a good thing. It indicates that markets are looking beyond this pandemic to economic recovery. And given the massive amount of fiscal and monetary spending that's occurred, and much of which will happen with a lag, the full impact of it, we're looking at some significant economic growth. So it's no surprise if all the stock is the present value of all the cash it can generate, that as discount rates rise or interest rates rise, the stocks that were very long duration are going to get hit the hardest. And that's some of the most overvalued of the growth stocks.
And yet we're going to have Congress. The House will pass the COVID relief bill tomorrow. Senate will follow soon after. Is this blip that we're seeing, and I'm only looking at the 10-year, but the yield on the 10-year above 1.5 right now, I mean, that's going to come back down. And wouldn't equities then go back up?
Maybe it'll come back down. I mean, it's a debate we have within Causeway about whether or not the Fed will get spooked by this and implement yield curve control, as we've seen in places like Japan. But remember, it's not just the U.S. where bond yields, the 10-year, have tripled from August of last year. It's also happened in places like Germany. In fact, if you look at all the sovereign bond yields across the board in the developed world, they've all gone up massively in the last 3 months. That to us is an indication that growth is coming, economic growth.
Sarah, you mentioned earlier there just about the fact that the action, I guess, that we're seeing in some of these high growth names, you're saying that some of those names are overvalued at this point. There have been conversations out there about whether or not we are potentially in bubble territory. Is there any area of the market that you think is in a potential bubble territory as of right now?
Well, I prefer to kind of talk about what still looks attractive. That so much more interesting than where not to go is where to go, because people still have a lot of savings. The U.S. savings rate is, although it's come off its peak, is still 14%. That's twice its last cycle average. And people have paid down their credit cards. Their home values have risen. So they need something to do with their money. And we think they're going to travel and they're going to spend on aviation, on hospitality. And there are still many stocks, including some great software companies. Oh, yes, software that aren't overvalued, that have far to go. Companies like Sabre in the U.S. and Amadeus listed in Spain. The two largely control the global distribution system market. They're providing software that make their airline, hotel, and rental car partners much more efficient. And their partners need them very much now because everybody's in rebuild mode. And even if it's 3 years to full recovery to get back to revenues that occurred in 2019, a peak travel year, just think that's a lot of growth between now and then. And these companies are really well positioned to take advantage of that and return quite a bit of free cash flow in the next 3 years to shareholders, as opposed to having to wait 20 years for it.
Sarah, I think what you've just described, many of us would refer to as as soon as I get the vaccine and I can, I'm on a plane to anywhere to get out of Dodge. And so we've been following the airline stocks have been trending higher. In fact, there was a note I read today that said short interest on some of the stocks that were most exposed to debt in the downturn has actually declined dramatically since the peak. So I'm not going to ask you to pick a stock. But would I be risking anything? Because I assume millions of Americans share that feeling, get out of Dodge as soon as we can healthy. Would it be a mistake to purchase directly the airline stocks, not necessarily Sabre, the software, but to look at those as purchases?
Airlines are, as you know, high fixed cost businesses, so they can be very volatile, and they have proven to be very volatile as equities. But there are some, one I'd name in particular that we find interesting is Air Canada, a little bit left behind versus the U.S. carriers, but has more of a monopoly in its own market. And its Canadian government's now coming around to providing some more support, as the U.S. government has done. But what all these companies share, which I think is really important for your viewers to understand, is that they have cut everything that isn't bolted down. I mean, the cost cutting, the cost cutting within operating expenses, some of it will never come back. So revenues, as they begin to pick up, will lead in these high fixed cost businesses to tremendous operating margin, operating leverage impact, and operating margins will increase. So in all the airlines may curiously be more profitable in the next, say 2 years or 3 years from now than they were in 2019.
Sarah Ketterer, CEO of Causeway Capital, thanks for joining us.